go.
Hi, everyone. Dale Pinkert here at TradeGateHub.com, sponsored by TradeView Markets. Today is going to be very interesting. We have with us today Mr. Blonde. Mr. Blonde, welcome to TradeGate Hub. And like I said, you could call me Mr. Silver.
That's great. Thanks, Mr. Silver. Appreciate it.
All right. Really great to have you. You know, I had seen your stream, your tweet. There was a tweet that attracted me to, the work that you did. And, I'm a believer that's not always the most popular people that are, hidden gems. Everyone knows about them. Sometimes the most popular people are better at marketing than the market. Okay, yeah. So, have you experienced that? So I'm intrigued by some of your work, but why don't we start with, what were you doing when you were 18, and did you think you'd be here now?
Oh, I definitely can't disclose what I was doing when I was 18. I'll get me in all kinds of trouble. But and no, the short answer is no. I mean, my journey through markets was one that, it's kind of like you come to forks in the road and you take a certain path, and then that leads to, to the next, place, and so on and so on. It was certainly not a premeditated destination, but it was thoughtful about each spot along the way. I mean, just real quickly, I spent time in a bulge bracket investment bank. Half the time there was on the research side, and then the other half of the time was in index equity derivatives. So good balance of understanding how to research markets, but then how to put all that stuff aside when you have to trade them. And then spent time at a equity long short hedge fund. Again, utilizing a lot of those same skills. And then from there spent a bit of time at a very large multi-asset, kind of long only type manager, where it was, kind of obviously sort of a lot of the same, skills used and developed. So at each point, I felt like I was building on the last experience and progressing.
Would you consider yourself self-taught, or did you have any mentors or people that influenced you along the way, that helped you along the way?
Yeah, that's a good question. Not to sound too arrogant, but it was primarily self-taught. And for me, I think that that's a big part of markets. I mean, you have to be intellectually curious. You have to sort of question, the data that's presented to you. And I'm a big believer, and I like to get my hands dirty and do things myself in order to understand things. I mean, of course, I had very good mentors along the way and early on that that helped to guide and encourage. But a lot of just good old fashioned, kind of get your hands dirty with the data and evaluate set of circumstances. And in the end, it's we're all sort of making judgment calls. We're just trying to improve the probability of being right and reduce the probability of being wrong. And
that's all we could control is what we risk. Yeah,
exactly.
Let me ask you, why did you choose Mr. Blonde for a handle?
Yeah, it's a good question. Not too many people have asked me that. Look, I'm a big Quentin Tarantino fan. I love his movies and the character aspect of them. I mean, I sort of felt like Mr. Blonde, had the right personality for markets. If you've seen the movie, he's kind of a little bit of a straight shooter, and kind of doesn't take anybody's BS. And I think that's a little bit of what markets are about.
You have to challenge the markets. I tell people that if they hear this thought in their mind, this thought, I hope this one works, that they need to shut down their platform, and walk away. How about stuck in the middle? Isn't that a lyric from a song?
Yeah, well, so if you remember from the movie, the famous scene with Mr. Blonde is when he's torturing the cop, right? Which is a little bit of the torture that we deal with in markets. And K Billy's Super Sound of the 70s is the station in the background, and they're playing Stuck in the Middle. Obviously, that song I think also has some market meaning, right?
Who did that song? Who did it? I forgot.
I'm embarrassed. I can't.
I hear it in my head. Stuck in the middle with you.
Yeah.
Right.
Yeah. The other thing that I like from the song is that you read the lyrics. It's like clowns to the left of me, jokers to the right. I mean, there's a lot of you could make a lot of market.
I mean, that's a great political statement anyway.
Also true. Yeah.
Jokers to the left, clowns to the right. So What I'm going to do now, Mr. Blonde, is I'm going to bow out a bit. And I know you went through a lot of trouble and prepared to show us what your methodology is, what you've learned. How many years have you been at this?
So geez, wow, it's 20 to 20, yeah, 20 plus years.
Okay. Well, it took me 40 to finally get that. I'm starting to get the hang of it. So,
Yeah, it's
anyway,
a
why don't you just
constant.
take, yeah, why don't you just take it away? Appreciate you putting energy into this presentation, and I'm going to let you just roll with it. Okay.
All right, that sounds great. Thank you
Take
for
it
having
away.
me.
Take it
Okay.
away.
Yeah, so look, I mean, first I wanted to, I kind of just thought I would give a little bit of a schematic about kind of how I approach and think about markets. I'm sort of a top-down macro thinker, and the weapon of choice for me is the equity market. Equity market can be anything from futures, ETFs, to single stocks, to baskets of, a long basket of stocks, short basket of stocks. I mean, obviously the beauty of the equity market is there's an infinite number of possibilities to express a view or to create a factor. The schematic I have, I think, is reasonably self-explanatory, but basically, I think of a couple different disciplines when I'm approaching markets. I have macro, fundamental, and quant as being sort of core disciplines, and then within that, my approach is to think about how much risk do I want to take, right? Net, gross exposure, what style risk environment are we in? Where do I want to allocate capital? What sectors? What geographies? What parts of the market do I think are most interesting given a macro regime or environment? And then selection for me as a macro minded individual is like style factors, right? Do I want to be growth, value, quality, beta, low risk? So like what parts of the market within those given sectors or allocations how do I want to express that view in a more specific way? So that's it, big picture in a nutshell. You kind of put all that together, and I think what you end up with is a quote unquote sort of macro equity portfolio, or what I think is the an optimal portfolio for the environment.
Does
Yep.
relative see, I already broke my promise.
No,
Does
it's fine. Fire away.
relative strength, going back to the old IBD days, I know
Yes.
you've been around long enough to know what that is, a part of your selection process,
Sure.
things that are showing, that should be down but are green when
Yep.
everything else is red. Okay,
Yeah,
just
absolutely.
curious.
In that quant bucket, I would maybe also kind of put quote unquote like technicals, which is not exactly what the IBD is, but the
Yeah,
other aspect of selection is momentum. I mean,
right.
you want things that are working, right? And you typically, and we'll get into this a little bit, but like working typically, or momentum, or that relative strength, is often a function of that group or stocks relative fundamentals, meaning like earnings momentum or some other characteristic, and they're usually aligned with the macro cycle and the regime. So I think
Okay.
that they're not there's just different ways to get to the same destination. So look, I mean, the other big part of what I do is I'm a data-driven individual. This is not about my feelings or like my opinion. I mean, of course, ultimately judgment is an important part of what we do, but in all of my work, I'm trying to develop indicators, quantitatively measured indicators that I can say like, okay, I think that this represents this particular variable. In this case, I'm showing how I think about growth, right? In this case, think of this as like a cyclical growth measure, something akin to like ISM, but a little bit more robust. But if I develop this indicator, I then can study it over the past 30, 40, 50 years, and then I can separate the environment into different regimes. Once I have different regimes, I can study how did markets perform in these different buckets, right? So think of like expansion is a period where it's above the zero line here and rising. Slowdown would be above the zero line and falling, right? Contractions below zero and falling. And so
Okay.
when I segment markets into these different buckets, I can more clearly see what should I expect to do well or poorly in a given regime. Now this is
Eh,
all coincidental work, right? Go ahead.
Okay. I was just going to ask you, so this is a proprietary
Yeah.
composite that you put together?
Yeah, and so
And then
I have the
and
components
then you
there.
go ahead and you show everything that's in it that you use
Yeah,
underneath it.
exactly. Yep.
Okay.
Yeah, and then all I'm really doing with the return study on the right is looking at the average monthly returns in different um in different regimes, right? And in this case, a
Okay.
regime is like the slope and the level of the composite. Okay, so now that tells me pretty clearly, like if I think we're currently in an environment and we're going to be in that environment for the foreseeable future, whether that's measured in months, quarters, or a year, then I have a pretty good idea of what parts of the market should do well or poorly, and that helps to define where I spend my time. Okay.
Okay. Got it.
Just obviously you have an indicator like that, and then you want to have like leading indicators of that indicator to help guide you and sort of serve as a roadmap for where you'll and give you confidence about where you're going to be and the environment that you're in. So for me, my indicator tends to be fairly, it's the business cycle, but in this case, the business cycle for me is primarily about the profit cycle, right? So within the equity market, profits represent the oxygen for the markets. When you have a lot of when profits are high or rising, right, when your earnings growth is high or rising, there's enough oxygen in the system that everything kind of does well and breathes easy, right? And so that creates a certain investment opportunity. When earnings growth is slowing and or negative, right, like parts of the market are going to be choked off, there's not enough oxygen. So and profits are basically the starting point for everything, right? I mean, companies don't hire if they don't have profits, they don't invest if they don't have profits. So profits are what creates kind of buybacks and a lot of the circularity that comes in markets. So that's one aspect. I mean, the other aspect
Okay.
is obviously just good old-fashioned PMI cycle. So my leading indicator for profits tends to be longer in duration, right? That's like a 12-month forward leading indicator. It gives me a pretty good idea of the environment for the next 6 to 12 months. PMIs are the thing that tell you when to act on that environment, like when to act on that environment. They're a little bit shorter term in nature. They're business, sentiment indicator. They tell you about, whether, rate of change, right? Things getting better, things getting worse.
So right now, most of your stuff is saying be out of the market, right?
Yeah, well, it's certainly telling you to be pretty defensive, right? I mean, now,
Okay. All right.
in fairness, like we're having this conversation today, but this is the message that I would have, delivered, 10 to 12 months ago as well, right?
Right.
I mean, this
Okay.
is
Yeah.
so, and of course, and we'll get into this. I mean, we're advanced in this cycle. This is not like early days. But again,
Exactly. Yeah.
just because
Okay.
we're advanced doesn't mean that you go the other way, right? You still I want to see my indicator show signs of a bottom, right? And
Right.
that inflection, tilting up before I get more offensive, right? In any way, outside of like short-term trading views.
In your experience of using your shorter term PMI, would you say that maybe 10% move in the market might occur before you get a signal,
Yeah,
or a
yeah,
10% decline before you get a signal
yeah. So I
to
would
get
say two
short?
things. I would say that what I have observed is my long leading indicator will show signs of turning first,
Okay.
meaning like
It's early.
yeah, right. And so but it's telling you about the turn,
Right. Coming.
9 to 12 months from now.
Right. Right.
And then what
Okay.
happens is then that basically tells you to be on alert and
Yeah.
more aware. And then you'll see the PMI turn. Now, in that process, I think what you'll see is like you'll tend to see within the market, you'll see more positive divergences. Certain parts of the market that were previously underperforming stop underperforming. Even
Yeah.
though the market itself in aggregate might still be going down, you
Yeah.
start to see things not making lower lows, right? And things of that nature.
Takes time to turn a battleship, doesn't it?
Yeah, that type of thing. Right,
Yeah.
exactly.
Right.
So now look, why is this sort of measure? For me, this is a measure of growth, and growth isn't the only variable, but within the equity markets, growth happens to be a very important variable. And I'll just share, these two charts to kind of highlight that, because obviously we've had this weird environment over the last 12 months where interest rates are rising, and a lot of measures of like cyclical growth are moving in the other direction, and that's somewhat inconsistent with the environment that we've had for the last 20 or 30 years. But the chart on the left is my macro growth composite, and then what I'm showing here is cyclicals versus defensives relative to their trend. Okay, so when that orange line is rising, that means cyclicals are outperforming defensives, and they're sort of doing so at an above trend rate, right? In this case, 12-month average, or think of like 200-day average, so they're rising above their 200-day average. on the, when it's falling, they're below their 200-day moving average and or falling, further below it. So, but you can see the relationship between the market and this growth, cyclical growth measure, right? Makes sense. It's, economically logical. Same measure for 10-year yields on the right side, and typically, has followed the same pattern in the last, 12 months or 10 months. We've kind of have diverged meaningfully from that because of Fed policy, inflation concerns, and I think above all else, interest rates or yields really didn't perform in line with the cycle in 2021. They was kind of held back, as a function of those things, and this year very much sort of released and played catch up. But
have you ever seen velocity like this in rates in your career?
Well, no, not in like my career. I mean, there was like probably a little bit of it in 2018, but this has gone this has gone farther than that, for sure.
Yeah.
Look, it's just the regime changed, right? And we sort of it was a little bit of like a beach ball being pushed underwater for a long time, and
right.
Inflation sort of released that. So look, the other thing I want to mention is, like, I talk a lot about growth. The Fed and policy obviously matters a lot. I did a whole note on this, and there's a Substack post. I mean, I encourage you and your audience to go and check it out. But did a whole history of Fed rate hike cycles and sort of quote unquote, what does it mean for the equity market? One of the things that I think is important to do is to kind of think about Fed rate hike cycles as not all being the same, right? You can have slow cycles, you can have fast cycles, you can have what I would call non-cycles. Clearly, the 2022 is a fast cycle, right? I mean, rapid hikes and a lot of them in a short period of time, and that naturally results in a very different style market. Back in December of 2021, I mean, there were people out there saying like, oh, the Fed's going to hike rates. Like, well, this is good because the markets usually go up when the Fed hikes rates. And they looked at like, the Fed hike cycles from like 1990 through present. It's like was total like nonsense analysis because that wasn't they weren't the conditions that the Fed was facing. So, a big part of what I do is try to go back and study as much history as possible, right? The more, when you're dealing with macro regimes and events, I mean, you need to increase your sample size. And unfortunately, I mean, if you only look at data from 1990 or 1985, I mean, by definition, you're only really going to have a handful of episodes. And so you need more episodes in order to kind of have a more robust and thoughtful understanding of what could happen. So here, I just really quickly, I just plotted, these are all the cycles. I red boxed out here the fast cycles, and you can see pretty clearly that fast cycles are bad for markets. I mean, we can, sometimes they're a little bad, sometimes they're a lot bad, but they all have that set of conditions. The charts on the left, I think, are important to keep in mind because this is sort of one of the dynamics that is different today in the context of the Fed's cycle, and that we know that Fed cycles typically mean you're going to have multiple compression. That part's not a surprise. Obviously, fast cycles, you have faster multiple compression because the discount rate is changing quickly, and therefore you have pretty significant kind of liquidity constraints, and that flows through vis-a-vis valuation. The other thing that was unique and different this time around is because the Fed decided to go late and fast rather than early and slow, like in the timing of their cycle, typically you would have a much more robust growth backdrop meaning like profit growth, meaning you would have growth to help offset some of that multiple compression. This time around, the Fed was sort of hiking into a cyclical growth slowdown. Right. Thinking back to the growth chart. So now what happens is
not a good cocktail, is it?
No, right, exactly. I mean, it's just a more aggressive version of financial conditions tightening. I like to say that there's two ways to tighten financial conditions. One is you increase discount rate, right? The other way is if you have a slowing growth environment, that's another form of financial conditions tightening. And in this case, we're burning both ends of the candle, right? Both things are happening at the same time. The cyclical growth slowdown is a function of just coming off of massive stimulus, post-COVID. So, you had a big boom, and now you're on the backside of that boom, and that just creates a more difficult, backdrop. Why does that matter? I mean, look, this is like equities in a nutshell, right? I mean, you have earnings growth or you have valuation. In this case, valuation driven by changes in cost of capital to determine your quote unquote sort of fair value. I mean, fair value is maybe not really the right term for this table, but like maybe think of this a little bit more as a floor value. And all I'm really doing here is just saying like, look, what's the cost of capital? In this case, triple B corporate credit yields. This is the rate that most companies borrow at, plus a 5-year average dividend yield, which sort of gets you that piece of pure equity risk premium on top of credit risk premium. You divide your EPS by that cost of capital, and you get a pretty good rule of kind of gauge or rule of thumb measure of like what's the quote unquote like implied price of S&P. And you can see the chart on the right plots that equation over time. What I would say is that this is like a little bit of a gravitational force, right? I mean, if you have the implied price 20% below the current price, it's just hard for the market to run away from you as long as these are the conditions, right? So okay. It's I'd say like this is like a trading environment that's 1 step forward, 2 steps back, right? I mean, we're like, it's kind of a little bit like quicksand. It's just not going to go that far as long as we have these that we have this cost of capital situation, and you're in an environment where earnings revisions are negative. Okay. This is just a little bit more detail on the valuation and EPS. So like the top left chart, I mean, it's true. I mean, so well, actually maybe start in the bottom left. So this chart shows the year-over-year change in Fed funds rate, the delta. So this is in basis points. Okay, so basically the Fed will have raised rates by like 550 basis points over the past year. That's a lot. And you can see how that compares to history. It's significant, and obviously this like makes it a fast, aggressive cycle. The blue line is the year-over-year change in S&P 500 PE multiple along concurrent with those rate hike cycles. So guess what? Fast rate hike cycles, you get a lot of multiple compression. This is like like night follows day. That's what happened this cycle. Now, I do think what's interesting is we're at a point where when you include current Fed funds pricing, this rate of change will slow, right? So we did a lot of the heavy lifting. Now from here, with measures of peak Fed funds rate at 5%, maybe we go to 550, maybe we go to 6%, but we're unlikely to go to 10, in my opinion. And so that means where the rate of change will subside a little bit. And I think my judgment is that means we probably have digested roughly 85% of the valuation pain that we'll have as a function of Fed cycle. It doesn't mean that valuations can't continue to creep lower. I just don't think they'll do it with the same velocity that we've had in the last 10 months. Okay. And so you can see in the chart in the upper left,
letting off the brake.
Yeah, exactly. Well, it's like we're kind of like, it's a little bit like want to be careful not to be like too but like it's a little bit like people talk about the pivot. I don't think it's so much the pivot as much as it is like the peak, right? Yeah. It's like it's like we've passed the peak momentum, and that's not the same as a pivot. A pivot is like a change in direction.
Right.
A peak is sort of like maybe it's
moving
like a peak
towards
and
a pause. Moving towards a pause.
Yeah, right. Something along those lines. So, and you can see the valuation chart in the upper left. This is just S&P 500. At the index level, we trade at roughly 16.5 times. But you take out like whatever some of the big tech stocks, and we're at 13.5 times. And you can see how that compares to the last 20 years. It's a lot of valuation compression has happened. If there's one concern I have, it's that we're using like 1 year's worth of EPS to determine valuation. But you look at the charts on the right, we have a profit cycle that's way above, we have profits way above trend. So, one of the things that I said coming into this year is we had a market, the set of market conditions where we had peak valuation. Well, we had peak liquidity, right? So like peak, Fed liquidity on peak valuation on peak earnings. That's a bad mix, right? To your point, it's a bad cocktail. And now I think we no longer have peak liquidity. That's pretty clearly been, adjusted. And we've done a lot of we chopped a lot of wood on valuation. We still have a peak EPS situation. You can kind of see how on the top right, how that compares to history. I mean, other than 2000 and 2007, we're running well above trend. And so we need to work that off, right? Either you have basically no profit growth for a few years and trend catches up, or you have some slowing and weakness and you catch down to trend. But my best guess is it's some combination of those. And so just kind of moving into the here and now, just looking at some of the earnings season, data that we have to date. I mean, I already showed my earnings growth leading indicator at the outset, which says that, come next year, we'll be looking at, down 15% year over year type growth numbers. Yeah. Everything that I've seen from earnings season, both 2Q as well as 3Q, is suggesting that we're on track for that. Okay. And I think that that's an important dynamic. I'll sort of direct the attention, really probably to the bottom left chart, because I think this is probably the most important for markets and traders. But this is, earnings revisions. I mean, you can see, irrespective of what companies report, and we hear on the headlines like, oh, company beat, like, they beat by a penny or whatever the number is, but nobody's telling you that, like, in the previous month or month and a half, that number was, taken down by 10 or 15%. It's like not exactly a beat. So,
and also the strength in the energy sector has been camouflaging the overall weakness in the market.
Yes, yeah, but even that's true. But even there, that has started to kind of fade too, with oil trading sub 100. Whatever. It's just the momentum.
Going to 108.
Yeah, right, exactly. Momentum there has definitely subsided. So revisions are negative. I think and then obviously I think one of the things that's still a little bit sort of concerning, but this is just kind of the way that markets work and consensus numbers work. I mean, the earnings, an earnings driven correction is slower, right? I mean, like a Fed driven correction happens quickly, right? It's an evaluation adjustment and there's a speed associated with that. Earnings, like, it takes place over a few quarters, right? Like there's a process of like, numbers, cutting and realization of that, kind of
more chronic than acute.
Yeah, that's a good way to put it. And so that's where we are now. And I think that's like, that will be something that kind of lingers with us over a course of a couple quarters, probably into the late first quarter of next year, if I had to guess. And look, the faster we come to agreement on where earnings will be in 2023, then the quicker we can kind of get there. This is just the busy table on the left, but it's
a lot of red.
Yeah, a lot of red. It just measures revisions. So we have revisions breadth. So like number of up minus number of down divided by total number. And on the right side is just the magnitude of the cuts. But yeah, the point here is that there's like nowhere to hide, right? I mean, revisions are negative everywhere. And so that is part of where we are in the cycle and the environment that it creates, and why it's hard for the market to run too far away from us.
No mother's milk.
Yeah, exactly. I won't spend too much time on this, but I mean, this was like something I highlighted a couple of weeks ago. Obviously the numbers aren't good, but you obviously have to also consider the setup and sentiment and positioning and other things. And one of the things that I've worked on and developed that I think helps to guide this is what I call sort of an earnings season sentiment score. This was one of the things that kind of got me to be a little bit more tactically constructive. At the very end of September, I called for sort of a bear bounce. I mean, it hasn't really been much of a bounce, but I think we can all agree that markets have been incredibly resilient over the last month in the face of a slew of negative headlines. And part of that is you get to a point where even if the numbers are bad, it's like the better than feared.
It's about positioning, right?
Yeah, positioning and what people are braced for, and then it's like, oh, okay, like that wasn't as bad as I thought it was going to be, and so there's a little bit of a relief that comes from that. Not everywhere, but broadly speaking.
Okay.
So look, that's it. That's like my big picture, and then I was going to give you just like real quick, kind of 3 trades that I like. If that works, but I'm happy to take a pause there real quick if you want to ask anything.
I'm interested in your, what you're looking for here.
Yeah. Okay. So look, there's some of these are existing trades, but I think they still have room to run. So one is, this is kind of like a way of being long vol or short risk without having a directional view on the market. And so what you're doing here is you're basically you're long low beta stocks and short high beta stocks, sector neutral. So meaning you're taking that exposure in each sector. So the reason that the sector neutral part is important is this is not simply like being long consumer staples and short like high beta cyclicals, right? It's not, it's you're taking that that low beta position versus a short high beta position in each sector. So it's a little bit more balanced. The reason I think that this is interesting and important, and it's a trade that I've had on basically all year, and still have on, is that it correlates well with financial conditions tightening, where we're still very much in that mode. You can see that in the chart on the left.
How do you put something like this on? I wouldn't
Yeah,
know.
so if you're an institution, you can do this vis-a-vis equity swap pretty easy. I mean, any of your major brokers will have an equity swap basket that you can do, and that's probably the most efficient and allows you a lot
What
of
if you're
liquidity.
Mr. Silver?
Yeah, if you're Mr. Silver, then you can buy ticker BTAL,
Okay.
Bob, Thomas, Apple, Larry.
Yeah.
And that's basically is designed to mimic this Dow Jones market neutral anti-beta index.
Wow.
And that's a way
And that's an ETF?
That's an ETF.
Wow. Okay.
Okay, so this is a way of, like I said, sort of being long. Think of this as basically being like long volatility, right? Or that internal market volatility, but you don't necessarily have the same negative carry attributes that you have if you wanted to be, long VIX. Okay.
Okay. Got it.
So, and I think the charts there kind of speak for themselves for kind of how this performs through different environments. Okay, the other one I like, which is is basically a way of being defensive within the tech sector. I mean, obviously tech is kind of front and center for a lot of the quote unquote problems that we have right now. And but I think that it's a big, large sector, and one that's hard to ignore. Or to not have exposure to in some way. I think that being long software, short semis is a way of taking advantage of where we are in the business cycle, meaning from here, we have more sort of earnings problems than we do valuation problems. Not that we won't still have, some of both, but, a wood has been chopped. So I like to be long software, short semis. You can see in the chart on the top left, which is a little bit just more of a technical. I think ultimately we're going to, kind of punch above this channel. I think it's nice that, in the face of a pretty difficult market environment in 2022, we didn't make a new low in this ratio.
But it's still holding the June low, isn't it? The bottom in June?
Yeah, so this ratio bottomed in around June. Right.
When
so first it bottomed in January, then it kind of tested again in June, and since then it's been, kind of trying
very
to
strong
higher
relative strength.
Yeah, a lot. Yeah, relative strength, exactly. And you can see the chart on the right, its relationship with the ISM cycle, right?
Yeah.
I think ultimately we have ISM below 50. Maybe works its way into the mid 40s. So I think that will be important. You can see on the bottom right, the fundamental relationship between semi versus software EPS. Okay, and this is not like rocket science. I mean, semis are much more sensitive to goods manufacturing and stuff, right? Physical stuff. Software as a group came into the year, clearly had a valuation problem, but its earnings profile tends to be a little bit more resilient vis-a-vis recurring revenue, subscription business, things of that nature. I kind of think of, like, listen, if we're worried about labor and wage growth, like I also happen to think that software is a potential beneficiary of that. And then you put that type of high productivity tool in order to help get more out of each worker. It had to go through a correction process because of some crowdedness and some valuation and things of that nature. Look, one wild card here, in my opinion, is if in 2023, if we get into a situation where rates are no longer rising at a rapid rate, you could have a situation where this kind of ratio, kind of starts to accelerate because you sort of lose the rate concern, but you still have a growth concern. And I think that would be to the benefit of software over semis.
What about Chinese retaliation? And it doesn't have to be an invasion of Taiwan, but what we're doing with chips.
Yeah, no, look, well, so that's another good point. I mean, the chips sector is complicated by that geopolitical sort of trade situation, really and supply chains and the cost of manufacturing, where you do that manufacturing, right? So there's a lot going on there. On the software side, you don't really have those problems, right? I mean, software lives in like the digital world, and so there is no such thing as a manufacturing plant, right? Okay, so
I just helped build your case.
Yeah, the last one is a little bit more of a short-term tactical thing, and is like about short-term mean reversion. But look, I like to try to take advantage of quote unquote dislocations.
Yeah.
Utilities is an interesting one. This is a pocket of the market that tends to be sort of very mean reverting, right? This is a low volatility, low business volatility sector. Obviously has like rate sensitivity and other things. More as a function of like it's, you know, it sort of is more famous for lack of movement rather than movement,
Yeah.
right?
So
It's kind of
it's
standing
changed. Its
still.
character has changed.
Yeah. And so this is what I did here is I basically look at utilities as a, you know, relative to their 200-day moving average. Okay. So what you're looking for is like, okay, how oversold or overbought something is. And then I basically look at that spread and I do it on a 2-year rolling Z-score, and I measured it from, you know, 1992 to, you know, present. And so historically, when you have a 3 standard deviation oversold condition, that usually is a trigger for mean reversion, and the sector, you know, kind of can then like rally back, right? You know, to you know, over the course of the next month. And you can see the statistics on the table on the bottom left. So
it looks like bonds may have bottomed, so that's a yield play.
yeah, that could
too, right?
definitely help. So this is, I think this is a nice way of like having long exposure in an otherwise like difficult market. It's you know, it's a trade. I think if you got back to 70 on XLU, you're probably saying like, okay, like that's, you know, that's good enough,
Yeah.
you know,
That's
type
fair
thing.
market
But that could
rally.
be a pretty, yeah, could be still could be a pretty, you know, juicy little trade in the short run. So that's
Well,
it.
Mr. Blonde,
That's all I
yeah,
had.
so
Right on 30
excellent,
minutes, man.
excellent. We could run over. Yeah, you did it unbelievable too. So excellent presentation. You're a
Yeah,
very
so I
deep
just have here,
thinker.
just, you know, this is where you guys can find me. So, you know, everybody can kind
Yeah,
of see, you
so
know, on Twitter, and then, you know, I kind of write some of these kind of comments and commentary, you know, with a little bit more detail at the stuck in the middle.
and you have a
But
subscription service, right?
yeah, you know, I just started that. It's been free for a year. I mean, I tried to, you know, give everybody more than enough time to you know,
Check you out.
digest the work, and you know, and it's I think it's pretty attractive price. I mean, I'm asking for, you know, $30 a month. I mean, this is mostly just a function of, you know, paying me for the time that I spend. You know, and that's, you know, it's, I think, whatever. I mean, people can decide whether that's
You're a
worth it
hardworking
or not.
guy. I could just tell from the presentation that you spend. I hope you sleep, Mr. Blonde. So
Money
you
never
know.
sleeps, Mr. Silver. You know that.
Okay, well, you're right, Gordon Gecko. All right. Anyway, really, I had a great time and I learned a lot from you today.
No, that's great. Yeah, I really appreciate you reaching out and taking the time to do it. And let's do it again soon. And hopefully these things will become, I won't have to explain as much, and we can kind of just get right into the trades.
Mr. Blonde, proving that blondes do have more fun trading the market. Thank you, partner.
Yeah,
You know
thank you, man.
what you know what happens to the people when they get through an interview with me?
What's that?
You become my trading warrior brother.
There you go.
All
Brother
right.
from another mother.
Thank you very much for sharing ideas, and really a hardworking guy, and you're a deep thinker, Blonde. So, you know, you're an asset for people to use in their intelligence gathering, in my extremely accurate and humble opinion.
That's great. Thank you very much.
All right, so that's a wrap, everyone. Check out Mr. Blonde at Mr. Blonde _macro. And we'll see everyone. Gosh, I'll be with Mike in an hour. So good hunting. Remember, don't just count your gains, count your blessings.